Hello everyone, welcome to another video. So today we're going to be going over a few things, particularly not so much technical analysis, but so much more just human behavioral analysis and also a bit of economic analysis. So what led me to this was actually when I was looking at the DXY, okay? So when I was looking at the DXY, and I did this video like earlier today, but I don't know what happened, but it just didn't record. I didn't hit record, so so I'm doing it again. Okay, so when we're looking at the DXY, right, we can see that currently we've been in an uptrend, right, since 2011, right? We can even say since the recession, right, in 2008, we have been in an uptrend. Now, that's not so much more my concern, but the concern is the reasoning as to why. All right, why in the midst of chaos and uncertainty that we see a currency that's still getting stronger, even through pandemics, through warfare, you still see a currency getting stronger. Okay, which brings me to the question of, or the topic rather, of inflation and interest rates, because in this week we have an expected another interest rate increase for this year, and economists do say that the dollar is sitting in a bubble, and there is the possibility of the bubble bursting, whereby we may see a further reduction in the value of DXY. Now, whilst that may be true, I don't think we will have that just yet. All right. So, what I found was that when we're looking at the DXY, right, and if you predate it, remember, like I always say, when you analyze, it's not so much so about this guy, right? We currently know where we are. So according to the four components of market structure, we know that the price is the least important one to us, right? But over time and how we got into this position is one of our most asked questions, right? So we want to know is how did we get here, right? Now, let's date back all the way to 2008, which is here, okay? Okay. Now, the reason why I'm doing 2008 is because we've had the recession, right? Crisis. Okay. Which obviously led to the value of the dollar being reduced to a very, very low price. Okay, as you can see. Now that we understand that we've had the recession crisis in 2008, okay, one can also say that since then, the dollar index has been in a consolidative state. Okay, there we are. Okay, there's no, this is it. So since then, we've been in a consolidative state. Now we know in a consolidative state, we've got our resistance, our support, but most importantly, we do have something known as the controlled price. Okay. There we are. Okay. Now we are saying that since 2008, there hasn't been a significant break to the upside or the downside. Okay. Until late 2014, early 2015, right? Which is around there. So our question is, what contributed to this increase in the value of DXY? Well, since 2004, in 2014, it was announced that there would be an interest rate hike, right? So there would be an increase in interest rates. Okay. Now, the interest rate hike only took place somewhere late December 2015, right? And early 2016. However, we saw the rise of the dollar in 2014. Okay. Now, this increase in the dollar was the anticipation of the increase in interest rates, which excited people to buy into the dollar, which is why we've had that increase in the value of the dollar, making it a powerful currency. Now, furthermore, one can now say, okay, since we've had that increase, okay, how many more people are coming into a market like this and expecting to place buy positions? Right? Then we have the notorious pandemic, right? Which is here, which is why we see that decrease in the value of the dollar. Okay. Now, this decrease in the value of the dollar didn't occur because we had a pandemic, right? It occurred because the Feds now realized that due to lockdown restrictions, etc., people losing jobs, the unemployment rate will increase significantly. So to combat the unemployment rate, the Fed policymakers would now cut the interest rates to try and balance out the increase in the unemployment rate. So inflation is affected by many things, which is unemployment rate, GDP, core inflation rates, and so many more, housing, all of these things, right? So if there is a tipping in the scale of one or the other, there needs to be some sort of equilibrium brought back into the into that state, okay? Which is why we have either an increase or the decrease of the interest rates. So that means in this area here, we now have a decrease in interest rates. Okay, and this is obviously 2020. There we are. Okay. Now we see that we're sort of inclining with the value of the DXY. So where is this coming from? Where is this increase coming from? This increase is now coming from the fact that we have inflation and a recovery from COVID, which is why we're having the increase in interest rates once again. Okay? So, inflation is a problem, right? It's a major problem. But to combat that, the Fed will have to increase interest rates. Okay? Now, what does this do? This makes the dollar look extremely powerful, which is why the shift from safe havens has now shifted to the DXY. Okay? So this makes it look extremely appetizing to investors when they are investing, because they see the strength in the dollar. Okay? Now, here is another reason as to why this would be regarded as the safe haven. Okay? Let's look at this, right? Let's look at this. One can also see that since we've had a bottom of the DXY, we can now say that this would become our, sorry about that, hey, doctor's handwriting. This would be our accumulation phase, right? Can everyone see that? So this area has now become our accumulation phase, which means ideally we are looking at something like that. Okay? Now, if we're using this as our starting point, right? And we look at the dollar from this aspect to say that yes, we have broken out of the accumulation phase and we can see an increase in the value of DXY. So if one had to take positions based on this to say that we are going to buy, right? So we have position 1, position 2, okay, position 3, position 4, and position 5, right? We have these 5 positions. Now, one can say that taking a position here is of good value, right? You're getting your value for your money, right? Compared to here. So this is extremely cheap compared to this guy, right? As price increases, even if one had to consider taking a buy position here, relative to this, it is cheap. Okay, so therefore we have some sort of retracement and we see another increase in the value. So if you take a position here, at position 2, price is relatively cheap compared to these areas and this area. So therefore, investors got in once again, right? Now, we know whenever the market comes back to retest a level, and especially if it's close by, this is a sign of institutional traders placing positions, because they place positions more or less around the same price level to avoid slippage. All right, and this would contribute to order splitting, right? So taking positions at any of these levels here is beneficial due to the fact that price is still relatively cheap compared to here, right? Now, now we see that we have key significant levels being broken, right? So if one had to consider taking a buy position here, it is still relatively cheap compared to our position here, which is why the dollar is still increasing, okay? And this is obviously besides the fact of the forced liquidation process, all right, whereby the ideology of let me rather write it, type it out. Okay. So this, what's currently happening now is abolishing this mindset. Okay. Because we can see in the midst of negative news, which is the Russian-Ukraine war, etc., we still see the dollar increasing. Okay. Inflation, what, we still see the dollar increasing. So this is why one cannot stick to fundamental analysis. One has to understand, yes, what is going on in the world, but cannot execute positions based on this. Okay. Now that we see the dollar increasing, we can now identify that even if one had to place positions at number 5, relative to this position here, it is still cheaper, right? The marginal utility may not be at its highest, but it is still relatively cheaper. So therefore, if investors now say that, okay, we've had some sort of interest rate hike and we can now buy from here, we may just get a small retracement to push price further to the upside. Okay. So that's the viewing of the DXY, right? It is all about understanding historically how interest rates and inflation rates affected the DXY, which is why now the DXY is looking so appetizing to investors. Because if you compare it to this guy, okay, we can see that since 2008, right, whilst the gold is regarded as a safe haven, it is not always that safe, because it is still facing the dollar, right? So gold itself is regarded as a safe haven, but gold against the dollar still has to succumb to the economic data that is released. Why am I saying that? Is because it's simple common sense. If the USD increases in strength, the gold will decline, which is currently what we are seeing. Right? Which is why in the midst of a war, we still saw a decline in the value of gold, because it's not that traders were fearful, it's just that the dollar looked more appetizing due to interest rate hikes, right? This is also over and above the fact of forced liquidations and all of that stuff. So we may just see a continuation of the decline in the value of gold before we see any significant increase in its value. So even something like this. There we are. And if you want to be fancy, you know, just to double and triple check. There. It will just retrace down to a 61.8 level and reverse. That's it, right? Which gives it enough time for the dollar to incline in its value to potentially force liquidate this previously formed high. That's all. Okay, that's all. So I hope this makes sense, and watch this video a couple times before you actually understand it fully. Alright guys, if you have any questions, you can obviously send me a message and then we can chat. Alright, thank you guys, catch you on the next one.